You know, the single best piece of investment advice I ever got didn't come from some fancy finance textbook. Nope. It came from a millionaire I knew when I was a kid. I asked him straight up, how do you pick the right stocks? And what he told me? Well, it's stuck with me ever since.
Treat it like finding a girlfriend. Now, at first that sounds a little crazy, right? But think about it. When you buy a share, you're not just buying a piece of paper. You're becoming a part owner of a company. It's basically a partnership. And just like any relationship, you want it to be a long one, a happy one, and a successful one. This isn't about swiping right on a whim. This is about looking for a serious, long-term commitment.
So if investing is like dating, then you absolutely need a strategy. You can't just wander into the stock market blind and hope for the best. You've got to figure out your approach. And really, there are two main ways to play this game, and they could not be more different from each other. On one side, you've got what's called technical analysis. This is the world of day traders, people who are glued to charts trying to predict tiny price swings. In our dating world, this is like trying to win someone over with flashy gifts and grand gestures. It's all surface level. It's a gamble. But on the other side, you've got fundamental analysis, and that's what we're going to focus on. This is like being a detective. You're digging deep into a company's finances, its brand, its leadership. You're truly getting to know them before you commit your money.
And here's exactly why we're taking that detective approach. Get this, a staggering 95% of day traders lose money. Let that sink in. This explainer is not about some get-rich-quick fantasy. It's about building real, lasting wealth for your future. So if you're ready to invest for the long haul, let's get into the nitty-gritty.
All right, so when you're on a dating app, what's the first thing you do? You check out their profile, right? You do a little background check. Well, it's the exact same thing with investing. Before you even think about committing, you have to check out the company's financial profile. And that always starts with something called the balance sheet.
Now, I know balance sheet sounds super intimidating and boring, but trust me, it's not. All it is a snapshot, a picture of a company's financial health at one specific moment. And to make it really easy to understand, let's think of it like a cookie jar. So, let's look inside this cookie jar. First, you've got your current assets. These are the cookies right on top, the ones you can grab right now. Think cash. Then you have long-term assets. Those are the cookies buried a little deeper, like the company's headquarters or its big machinery. Intangible assets? That's the secret family recipe that makes the cookies taste amazing, the company's brand, its patents. And then there are liabilities. These are just the cookies you've already promised to your friends. In other words, the company's debts.
So with that in mind, can this company actually pay its bills? Here's a super simple check you can do. Find the total current assets, remember the cookies on top, and divide that number by the total current liabilities, the cookies you owe soon. Let's use Coca-Cola for example. You take $26.73 billion, divide by $23.57 billion, and you get 1.13. What does that mean? It means they have $1.13 in easy-to-get cash for every dollar they owe in the short term. Anything over 1 is a pretty good sign.
Okay, next up. When you're getting to know someone, you're probably curious about their track record, their past relationships, right? Well, in the investing world, that's called the income statement. The easiest way to think about it is like a company's report card. It shows you exactly how much money it made and how much it spent over a year or a quarter.
So how do we grade this report card? Here's another simple calculation. Find the company's operating income and divide it by its total revenue. For Coca-Cola, that gives us a profit margin of almost 26%. To put that in perspective, any profit margin over 20% is generally considered really, really good. So yeah, Coca-Cola is definitely passing with flying colors here. And finally, the last piece of the financial puzzle. Look, you would never want to get into a serious relationship with someone who's just terrible with money, right? It's a huge reason why relationships fail. That's why we have to look at the cash flow statement. This document shows us exactly how money is moving in and out of the company. And reading this is pretty straightforward. For operating activities, you want to see a positive number. That just means they're making more money than they're spending on their core business. Easy enough. For investing activities, a negative number is actually a good thing. It shows they're putting money back into the business to grow. And for financing, you're just doing a quick check to make sure they're not taking on too much debt or paying out crazy dividends they can't afford. Okay, so we've done the background check. The numbers look good. The company seems perfect on paper. But just like with a date, sometimes there's just no spark, right? This is where we have to look beyond the spreadsheets, at the things that numbers can't tell us. This is what we call qualitative analysis.
So what creates that spark? Well, first, there's brand recognition. I mean, think of Apple. People know it, they trust it. That trust is incredibly valuable. Second, company leadership.
Who's running the show? Are they sensible? Do they have a good track record? And third, what are their competitive advantages? What's their secret sauce that no one else has? For Tesla, it's their groundbreaking tech and that massive charging network. These are the things that give a company real staying power.
And speaking of leadership, let me show you a wild example. Back in 2016, then President-elect Donald Trump fired off this tweet about Lockheed Martin's F-35 fighter jet program. He said the cost was out of control. It's just a single tweet, right? A few characters on the internet? How much damage could it really do?
$4 billion. In a single day, nearly $4 billion of the company's value just vanished. Poof, gone. This is such a powerful reminder of why you want sensible, stable leadership. Sometimes all it takes is one tweet from the wrong person to send investors on a very, very bumpy ride.
Now let's talk about the hard part of any relationship, the drama. What do you do when bad news hits? What happens when you hear a nasty rumor? In the investing world, that drama causes people to panic. They sell their stocks based on emotion without really thinking things through.
A perfect case study is the big Facebook Cambridge Analytica scandal back in 2018. The news broke and investors freaked out. The stock absolutely plummeted, down almost 18% in just 10 days. But the investors who had done their homework, who still believed in the company's long-term fundamentals, they held on. And since that low point, the stock has grown over 200%. For them, all that drama was just a blip on the radar.
So, when is it actually time to break up? Well, the best reasons to sell usually have everything to do with your life, not the market's crazy mood swings. Maybe you have a financial emergency and you need the cash. Maybe you've hit the goal you set for yourself. Congratulations. Or, and this is the big one, maybe your detective work tells you that the company's core business has fundamentally changed for the worse. Those are all solid reasons to walk away.
Okay, look, you wouldn't marry the very first person you go on a date with, would you? It's smart to play the field a little, see what's out there. Well, the same thing goes for investing. You never ever want to put all of your eggs or all of your money into one basket, one single stock. It's time to build a portfolio. As you start playing the field, you'll find there are two main types. You've got value stocks. These are like the stable, reliable partner. Think huge companies like Procter & Gamble that are steady and pay you dividends. Then you have growth stocks. These are the more exciting, high-potential partners. Think Tesla or Nvidia. They're definitely more volatile, but their potential for growth is massive. A lot of smart investors build a portfolio with a healthy mix of both.
So how do you play the field safely? It's all about diversification. Just follow these simple rules of thumb. Don't put more than 5% of your money in any one stock. Don't put more than 20% in any one sector, like tech or healthcare. Try to invest across at least 5 different sectors and in at least 2 different countries. That way, if one of your dates doesn't work out, it's not the end of the world. The rest of your portfolio is there to balance things out.
And that really brings us to the final question. After all the background checks, all the financial detective work, feeling for that spark, you're left with a choice. Have you found the one company you're ready to commit to? Or is it time to start playing the field and building a well-rounded portfolio of partners to secure your financial future? That choice is all yours.